Chapter 17, cash flow statement. Interesting chapter, important chapter, because it's going to show you how, from where the cash coming from and from where the cash going and how we prepare the cash flow statement. Let's start first with the cash flow statement. Cash flow statement, again, shows you from where the cash coming from and for what purpose we're using the cash. Also reports why the cash increased or decreased during the period. So we're going to chase few things. On the balance sheet, we're going to see the beginning balance of cash, and we're going to see the ending balance of the cash. That's going to show us either increase in cash or decrease in cash during the period. Now, once we see that, we want to know from where the cash came from and for what we spend that cash. Why the beginning balance is this, ending balance is this, and then what's happened in this account, debit and credit. So basically, we're going to do close analysis in the cash account. The same thing that you're doing when you open your bank statement. When you open your bank statement, at the beginning of the month, you have beginning balance, and at the end of the month, you have ending balance. And then you want to see from where the money came from and on what I spent my money for. So we're going to cover the same period of time as the income statement. So if the income statement we're preparing for 1 year, cash flow statement is for 1 year. If the income statement is for half year, cash flow statement will be for half year. So how this works, financial statements and timing of the financial statement. Few things what we have to do, is the time up to this point, as we know, as we experience, coming from in one direction, from the past to the future. That's how we explain the movement of time from one direction to another direction. One direction is called past, the other is direction future, and we have the present in the middle. Now, what we're going to do, in the beginning of the start of the time, let's say start of the month, we're going to take a picture at this point of time. And that picture will be our balance sheet. After that, the time starts moving forward. And once the time starts moving, we're going to set up periods, 1 year or 1 month or 1 year or 3 months or 1 week. Obviously, 1 week is not a reporting period, but we're going to set up the reporting period for the company. The shortest reporting period of the company is a month. Longest one is going to be a year or operating cycle of the company. So once the time start passing, events start happening. Those events will be captured by different statements on the financial statements of the company. During the period of time, the company is going to have opportunity to generate revenue and to generate expenses. Also, during that period of time, those revenue expenses, they're going to have directly a reflection on the statement of the retained earnings, since you know that revenue minus expense is going to give you operating income, and that operating income is going to go to the income summary account. Income summary account is going to be closed in the retained earnings, which is part of the statement of retained earnings or statement of owner's equity. And at the end of the period, we're going to make another picture, which will be again at the point of time. And then we have the starting point. Let's say the starting point is December 31st, which magically happened to be January 1st as well. We're not talking about January 1st, 11:59. We're talking about January 1st, 000. Until December 31st, 11:59 of the same year. Now I have 1 full year. It is going to be 365 or 366 days, depends on the year. But now we have to find out, at starting point of the year, I have this. At the end of the year, I have this. If there's no changes, nothing. That means nothing happened. But if there's a changes, we have to find why there's a changes. Did we generating revenue? Did we generating expenses? How this reflected the retained earnings? And on the cash side is how much was the big cash in the beginning? How much is the cash at the end? What's happened with the cash? analysis of the cash account is going to show us from where the cash coming from or what gives the increase in cash. Everything that we receive as a cash is give an increase in the cash. Again, beginning balance, beginning balance. Then we start collection from the customers affect our cash. Interest, which we receive as a cash on the notes receivables, that's going to give us increase in cash. If we issue shares, investors give us cash. That's going to increase the cash. If we issue the bonds, create a long-term liability, we borrow money, that's give a raise of cash. If we receive the dividend, cash dividend from another company, that's going to give us cash. If we borrow funds from the bank, that's also increase the cash. Now, where the cash going? We can pay those suppliers on accounts payable, or we can pay the employee, or we can pay income taxes, or we can pay for the assets, or we can give the loan to another company, or we can decide to pay the dividend to the shareholders. Or if we already borrow money, we may decide to repay the loan back to the bank. If we already borrow money through the issuance of the bonds, now we can repay those long-term loans, including the bonds. At the end of the period, we're going to see how much was the cash in the beginning, how much increased during the period, how much decreased during the period, what's the ending balance. The purpose of the cash flow is probably that's the most important statement because the bank's not going to give you a loan until you have a cash flow statement. The interesting part with the cash flow statement, there is no software in North America which can prepare your cash flow statement. I'm sorry, there's no such software. Every basic software can prepare income statement, statement of owner's equity, balance sheet. That's it. Cash flow statement, you have to prepare it by yourself. Why do we need that cash flow statement? Why the banks are so picky on this cash flow statement is because it can predict what's going to happen with the cash in the future. What the bank wants. The bank wants to make money. How the bank can make money from you? By lending us money. What the bank wants? Their money back plus the interest. So what the bank wants to predict, is this company generating cash on the regular basis to be able to pay me my interest plus the principal when the time comes. Also, with the cash flow statement, we can evaluate the management decisions. Is this the right decision that the manager took by investing in this project or spending money on this merchandising, buying this merchandising, by simply comparing how much they pay versus how much they get. Also, we can determine the company ability to pay dividends and debt. Again, all the investors, the only thing the investor wants is not the wealth of your company. They want their personal wealth. How they can get personal wealth? By dividend. As long as you're generating positive net income, which net income you're giving us to the shareholders as a form of dividend, cash dividend, that's what they want. They want, is this company has ability to generate cash so they can pay me dividend. And the other thing is that shows the relationship of the net income to the cash flow. And obviously, net income has nothing to do with the cash flow, but at least we can see some relationship between those two numbers. The other purpose of the cash flow is that once we see a negative cash flow, obviously you're going to see the investors running away from the company unless they're willing to take a risk. But if they take a risk, then you have to pay them high premium in terms of interest or dividends. So now, negative cash flow from operations, that warns that the company has a problem. If you have negative cash flow from the operating activities for more than one period, 2 consecutive years. I'm not going to go with more than 2 years. If you have a negative cash or from operating activity for 2 years, you're in trouble. unless you're using company from some other purposes, but that's not the purpose of this course. Let's go with the what is cash and what we're chasing here. On this cash flow statement, we're gonna analyze changes in cash. Now the question is, what's cash? Cash is everything that's sitting in the bank account plus cash equivalents. So now on some CPA questions, I start seeing this, the company has that much cash and they have some short-term investments. Those are cash equivalents, so they're part of the cash. Remember this, if you see something like that, that's part of cash. So what will be considered short-term investment? Everything that can be easily converted to cash. Anything related to money market funds, some Government of Canada Treasury bills, some GAC if it's cashable, that's directly cash. Now, you have to be careful because you have different types of GAC. Let me if I can simply show you those type of GAC, which is guarantee investment certificates. Let me see if I can easily get it so you can see it. And you can see actually how this what's the difference between one and the other, and we can talk which one is cash, which represents a clearly picture of cash, which is not cash. Trying to find something very quick here so I can show you. Cannot find anything right now. So I don't want to waste too much time here with this one. Maybe on the break I'll try to find something which is super obvious so you can see what is one, what is the other one. Usually they have some very, which is explicitly say, I found something here, just let's quickly change the sharing and I'm going to show you this. So for example, you can see here different on the non-registered GAC, and you can comparative rates guarantee that you have guarantee investment certificates, which are from you have some promotional rates, just random bank, and they give you some percentages. The whole point is what's the GSC? The GSC is the reliable investment. You have safety, flexibility. You can go with the short term and long term. You can go with cashable and fixed. If you go with the cashable, that means this one is for 1 year term. So if you put your money, those money are locked for 1 year. If it's locked for the 1 year, that's considered short-term investment. But if for example, you're going for the flexible, you're still getting the interest, but this one is cashable. What means cashable? You can, anytime when you need the money, you can close this GAC and you're not losing the interest. In the contrary, you're still getting the interest up to the point of which you get the money back. So that's something. Though that will be considered cash. If your company keep the cash in the flexible GAC, which is cashable at any point, that will be considered cash. So let's go back to the slides and keep going with the slides. Not this one. I'm still going with the same thing. That should be the slides. So that will be your cash equivalent. Anything which cashable, that's a cash equivalent. And that's going to be part of the cash. So the cash is not only the money that cash money, but that's all in all the bank account money, but also all those guarantee investment certificates which are cashable at any point. So let's see what will be on the cash flow statement. Cash flow statement, we're going to have different activities. There are three basic categories on the cash flow statement: operating activities, investing activities, financing activities. And we're going to have three sections, which section is going to be for every single of those activities. Now, only and only for the operating activities, we have two ways to prepare that particular part of the cash flow statement. We have direct method and we can use indirect method. Both methods arrive with the same results. So it doesn't matter which method you're going to use on the operating activities. On the accounting standards, CPA Canada Handbook and accounting standard boards, they approve both, but they encourage practitioners, you in the future, to use the direct method. However, most of the company, including in this course, I'm going to show you only and only indirect method. And you're going to be tested only on the indirect method. Direct method is not going to be tested because the practitioners in the industry, they find the indirect method more practical. What's the difference? The difference is how we treat different elements of the balance sheet and income statement and how we come up with the numbers up to some point. But we're going to talk about a little bit later about this. So again, three basic categories, which including operating activity, investing activity, financing activity. Only for the operating activity, you have two methods: direct method, indirect method. For the everything else, only one method. Operating activities. In operating activities, we're going to catch everything that create revenue, expenses, generate gain, and generate losses. We're going to chase what's the effect on the net income on the income statement. We're going to chase the effect of the current assets and current liability on the balance sheet. This probably is the most important cash flow part of the cash flow statement. Why? Because it gives you an idea what the company can generate from the operating activity for which the company was created for. If I'm a merchandising company, I want to see how much cash I'm generating from merchandising activity, which is my operating activities. Everything else will be peripheral. Investing activity, in the investing activity, we're going to chase any increase or decrease in the long-term assets, purchase and sell of those assets, which including any long-term loan that we might lend to the other people or collection of those loans. This one is considered the second most important after the operating activity because this one's going to give you idea, is this company spend money for the company sustainability or not? If the company not investing in the company sustainability and the company future, most likely that company is not good for investment. The last part is the financing activities. The finance activity is going to chase increase in the long-term liability and everything related with the owner's equity. That means issuing shares, paying dividend, repurchasing company owned shares, borrowing of the money, paying the loan back. And this one is as you can see, is related to the debt. So if we have to go back, let's go to Excel spreadsheet and show you. If we have to go back to the basic accounting equation, which basic accounting equation we're going to show you here on the Excel spreadsheet. We already know it, but let me remind you about the basic accounting equation, which is simple asset capital A is equal to liability. Let's leave some space here because I need some space, and you're going to see later on y equal to liability plus equity. Now the question is, what kind of assets I have under the assets side on the right or the left side of the equation, and what I have on the right side of the equation as a liability and equity. Well, we already established through the course, this course and the previous course, that under the assets we have the current assets and we have a long-term assets. Same thing is applicable to the liability. We have current liability and we have a long-term liability. On the equity, we have just equity. Now, on the equity section, we saw this course, this term. We have contributed capital, which comes from investments from the owners, shareholders, and we have the retained earnings. Retained earnings is the one that's coming from the income statement. So, cash flow statement. On the operating activity, we have three sections. Let's put this one right here. We have three sections. We have operating, we have investing, and we have financing. On the operating activities, we're concerned only and only with changes in the working capital. Which is our working capital? Our working capital is the current assets and current liability. That's your operating activity. Investing activity, as we said, that's related to the long-term sustainability of the company, means where the company investing. That will be our investing activity. Long-term assets are related to the investing activity. And then we go into the financing. On financing, it's related to long-term liability, long-term debt, and equity section, which is including the contributed capital. Either people investing, either we buying our shares back and retained earnings. In terms of are we paying dividend or not from the retained earnings. So that's your cash flow statement. Cash flow statement catching operating activities, which are working capital, current assets, current liability, investing activity catching the long-term assets, and financing activity catching the long-term liability, and the changes in the equity section of the balance sheet. Those are elements of the balance sheet as we already know. What we're going to do with the income statement? Income statement, we're just going to get with the net income, and we're going to start working with the net income. That's our starting point. And that's for the indirect method. Let's go back to the slides. And repeat what I just said. So operating activity in the cash flow statement is going to deal only and only with the working capital, which is current assets and current liability. Investing activity is going to focus only and only on the long-term assets. So for the financing activity, left only two sections, long-term liability and owner's equity. What we're going to do with the discontinued operations, those are going to be shown separately on income statement and the cash flow statement. How about the interest in dividends? Now there's a catch here, and you have to think from purely operational and the way the company works. During the normal operation, the company may uh, have a leftover cash, which cash can be invested for the short period of time. On that investment, the company can receive interest. When the cash from the interest is received by the company, the question is, are we going to treat it as a part of the operating activity or is it going to be part of the investing activity? For the interest which we receive, company receiving of uh, generating some return on the investment, that will be considered part of the operating activity, unless otherwise is specified. There always that exception. How about the dividend that company receives? Since the company investing, company can invest, can borrow, or can lend the money to somebody, or can invest in some stock market or stock shares of the other company, and those shares going to give a dividend. How about the dividend that we're receiving as a cash dividend? Those will be part of the operating activities. Now, if we need cash and we borrow money from the bank, how are we going to treat the payment of the interest, which we have to pay on the installments over the period of time? That will be part of the operating activities. Only and only the dividend that we paying to our shareholders will be part of the financing activities. So what you have to remember is interest paid, received, operating. Dividend received, operating. Dividend paid, financing. That's how the general rule is. Now, some of the question might say something different, but the question should be the one who gives you the ideas which you're going to treat part of which activity. But the general assumption is interest received paid, operating activity, dividend received, operating, dividend paid, financing activities. What we're going to do with the non-cash investing in financing activity? Nothing. We're doing nothing. We're doing a cash flow statement. Everything that is not related to cash is not part of our investigation of the cash because it doesn't give a rise of cash. It doesn't give us use of cash. For example, I'm buying machinery with issuing a long-term debt. Is cash involved? No. I'm signing the note payable, which I'm going to pay in 20 years, and then getting the machine. So I'm getting asset, increase the asset, and increase my liability. How this going to affect my cash? No effect on the cash. So not part of the cash flow statement. Now we may have a component of the cash and some transactions, but in that case, we're going to chase only that component. And that will be for the investing and financing activities. So for example, we purchase machinery for which we pay down payment of $5,000 cash, and the rest of the amount, for the rest of the amount, we issue a notes payable. So part of our cash flow statement investigation, and we're going to include in our cash flow statement only the cash that went out for that machinery, which in this case is $5,000. The other $20,000 for which we issue notes payable, that's not part of the cash flow statement. So, free cash. What is the free cash? Free cash is going to give you the amount that is available from operation after paying the planned investment in the long term, and that's going to give you the ability of the company to repay the debt and pay dividend. That free cash, we're going to simply measure it by deducting from net cash provided from operating activity. We're going to deduct all the cash payments for the investments in the property, plant, and equipment and other long-term assets. So we're going to get what we have as working capital, current cash minus the long-term current assets minus long-term liability. We're going to see what's the cash portion of that calculation because we have net of cash from the by the operating activities. So we're going to see how much we generating from the operating activity. From that cash that we generate from the operating activity, we're going to deduct all the investments in the property, plant, and equipment that we're planning to make for company sustainability. We're going to deduct any long-term assets that we're planning to purchase, and that will be our free cash. What we're going to do with the free cash? So many things. With the free cash, now we can start looking. Can we repay some of the loan if we have a loan outstanding? If we don't have a loan outstanding, just give it to the owners or give it to the shareholders. Make them happy. Now we're going to start preparing our cash flow statement by using indirect methods. Before we do that, we're going to go back to the Excel spreadsheet and I want to do some brainstorming. I want you to start feeling comfortable with the cash first, and then we're going to move to the back to slides and go with the slides. Gonna open a new here worksheet and gonna work on this new worksheet. Let's increase it first. Generally, in accounting, everything is simple. We try to keep it simple. Simple it is, easy to understand. But in reality, life is not that simple. There are always complications. I mean, obviously there's exceptions, there are exemptions, but basically we can not always predict what's going to happen. So for that reason, I'm going to use here the T accounts, and we're going to find first from where the cash come from. Where is our cash in? So this is our cash account, which cash account is the balance sheet account. We already know the balance sheet account, part of the assets. Since it's part of the assets, it's going to have a beginning balance and it's going to have the ending balance. Ending balance is going to be this, all this part will be our debit, and the other side we're going to have credit. Simple, easy to understand balance sheet account. What do we know about this account? We know that debit plus, let's start with the beginning balance plus the debit during the period. It's always equal to the credit during the period plus the ending balance. Beginning balance and everything on the debit side is going to give us cash available. Credit is going to give the cash that we paid. Cash available minus cash paid is going to give us ending balance. We already know that. Now let's change where the cash coming from. You want the cash to come for so many things, but in the company normal operations, in the normal life, in the company operation, cash comes from only and only one activity, which is called sales. So in order to generate cash, we have to generate sales. Or in other terms, we have to generate revenue. So for that reason, we're going to create here a new account, which is revenue or sales. And that's from where the cash coming from. If you don't have the revenue, you're not going to see cash. I'm sorry. That account is part of the income statement now. There's no beginning balance here, no ending balance, nothing. So this account also have debit, also have credit. Income statement. Accounts usually on the credit side give the raise of the owner's equity. So everything that get the revenue on the credit side gives the rest in the owner equity. Everything on the debit side reducing the owner equity. Sales usually always and always happen to be part of credit. Always credit. We already know that. Let's move it here. It's always increase happen on the credit side, not on the debit side. Debit side is the actually debit side is forbidden for the sales and revenue. You have other accounts if you want to create sales and revenue. You have sales discount, you have sales allowances, we have all the other accounts, not this one. Okay, so what's going to happen? Every time when we generate sales, 100, we're going to have, our idea is to collect the cash, right? Or to collect the sales. If we collect it right away, life is beautiful. Let's insert one shape here. Which shape's gonna look something like, I'm trying to find something which is easy for me to manipulate. Interesting. I cannot find anything in those shapes. Anyway, let's go with this simple shape. So if I have $100 cash, I want to see those one sales. I want to see that sales right here in my cash, correct? In the perfect world, if we collect all the sales and revenue, that's gonna give us increase in our cash. What's interesting with the real life? That's not true. This chain is broken. Now, if we break this chain, the question is, let's find something that breaks the chain. This chain here is broken. So the question is, what's on the middle? That means I'm doing the sales, but I'm not collecting cash. That's called sales on account, correct? So in the middle, I'm going to have a new account, which is going to be accounts receivables. And that creates my complication because accounts receivables is also asset account and look like very much like this cash account. Since it's the asset account, has beginning balance, has the ending balance, everything has debit, has credit. Now, what's interesting in this account? The interesting part is if we're not collecting the cash with our sales, that means those $100, the part to go from the sales to cash takes one more step. What is that? Accounts receivable. So first we're going to generate the sales, which is going to increase my accounts receivables. And then I'm going to decrease my accounts receivables. Let's put it down here. I'm going to decrease my accounts receivables and I'm going to collect my cash. So my sales doesn't become cash right away. I need to go through the accounts receivables. So the first part will be, let's go with this again. First part is my sales gonna become accounts receivables. And once I collect my cash, my accounts receivable will disappear and I'm gonna have my cash. Make sense?
So the
Are you,
reason why the circles in the middle and like the revenue
because
become
the chain is broken. Because we not if in the real world, if I collect my revenue directly, if I run in cash business, I don't need accounts receivables.
okay,
Make sense? If I'm running cash business, this account, I don't need it.
okay.
Bye bye,
Oh, I see. Okay, that makes more sense. Thank you.
right? Why? Because directly I'm directly collecting my cash. If I'm running like a hot dog, what will be that? Catering or hot dog uh, car outside, sitting in front of your office, and I say, "Oh, you want a hot dog? Yes, give me $10. I'm gonna give you a hot dog. No $10, no hot dog." So my sales is directly related to my receiving the cash. But in most of the businesses, that's not the case. Most of the businesses, they're not collecting cash right away. So that's why this chain here is broken. And accounts receivables come in play. Now let's see something here interesting. And I want you to think about it. Let me make it easy for me to manipulate those numbers. So the question is, if my since we know that this formula apply on all the this is accounts receivable is also balance sheet account. That means beginning balance plus the debit minus the credit is going to give us the ending balance. Make sense? So the question is, if my sales are $100, my accounts receivable account balance is zero. My accounts receivable balance is ending balance is also zero. How much cash I have collected? Let's see what you say in the chat. $100. Is that obvious for everybody? What's going to happen? Those $100 going to come here, $100. After here, I'm gonna collect it and then gonna go to my cash. Why? Because my accounts receivable balance is zero. My accounts receivable ending balance is zero. So debit is equal to credit. That means sales that I generating has been collected in the cash. So where can I find my sales in my cash? Make sense? Are you guys with me?
Yeah, that makes a bit more sense, Ivan. Yeah, I think I'm beginning to get this now.
Okay, so now let's do some thinking here. If my beginning balance, let's forget about this. Or maybe let's go here. Accounts receivables 0. Now let's play a little bit with this. My sales are 100, correct? My sales are 100. My beginning balance of accounts receivables is 0. But my ending balance in accounts receivables is 20. How much cash I have collected? Did I collect my sales? We already saw if my balance here is 0, that means the $100 that come in here is the $100 that I'm collecting as cash, correct? That means I have collected my sales. If there's no change in the beginning balance and ending balance, if the beginning balance and the ending balance are equal, that means I collected my sales. Now, I know my sales are 100. My ending balance in account receivables now is 20. Did I collect my $100 sales? Yes or no?
I was about to say no.
That will be the right answer.
Okay.
No, I haven't collected my 100. So the question is how much we collected. And that now Xiaolin comes in the
80.
picture and she says 80. What's happened? Those hundreds gonna come here, correct? Now I'm gonna have 0 plus 100 minus the ending balance. So what I'm gonna have here? My beginning balance is 0, correct? Plus I'm gonna have 100 here. And that should be equal to my credit, which I don't know, plus my ending balance, which my ending balance is 20. How much my credit? 80. Make sense? If I put here 80, those are the ones that I collect. Okay, that's when we have the accounts receivables with the ending balance. Let's see new scenario. Oh yes, I did that. That should be credit here. Thank you. I don't know why I put that. That's totally wrong. You're absolutely correct. Let's fix it on the previous one as well. Okay. So now, let's go a little bit further. We're gonna leave the cells in 100. But now, let's play with something else. My accounts receivable balance at the beginning of the period was 30. My ending balance is 0. How much cash I collected? No, before we answer this question, first I want you to tell me, did we collect our sales for the period? Yes or no? Yes. Is that clear for everybody?
It is to me.
Okay. So the question is, since we collect our sales 100, how much cash in total we have collected? Is that all?
130.
Is that obvious for everybody?
Yeah, it's
Because
130, right?
right. So why
Okay,
why?
good.
Because this cell is gonna move here 100. Now
Yeah.
I'm gonna have
So,
130 to collect, but
yes.
my ending balance is 0. So that's mean how much I collected? 130, which will move to the cash. Make sense? How are we gonna express it here in the formula? Formula will be 30 plus 100 should be equal to I don't know how much plus 0. And once we flip it, that means I collected 130. Question mark is equal to 130 here. So far, so good?
Yep.
Okay, let's go further then. Let's keep going with the exercise and make it a little bit more difficult now. Let's flip this one here now. We don't need this formula, we don't need this formula, I don't need this, I don't need this, I don't need this, I don't need this, and I don't need this. So, again, my sales are 100. But now, my beginning balance is 20. My ending balance is 50. How much cash I collected? Can everybody see the $70 that we collected? Let's apply the formula. My beginning balance is 20, correct?
Yes.
My sales are, how much is my sales?
100.
100. No questions about it. Debit and accounts receivables are my sales, 100. On the other side, what I have? Question mark. I don't know how much I have collected, but I know that my ending balance is 50. So where is my question mark equal to? I have 120 minus 50. And that's going to give me
70.
$70. What that means? I collected $70. That brings us to the question, did I collect my sales?
Up to a degree, in my opinion, because like
How much of my sales I collected?
you only collected 70,
70.
which, yeah.
Make sense? Yeah, you can say, Xiaolin, you can say we don't know. Because technically we collecting $20, we might collected $20 from the beginning balance and only $50 from the current sales. But we don't know exactly how much. But having in mind that accounts receivables also comes from the sales from the previous period, and everything is sales, so that means we collected $70 from our sales. So what that means to us? That means if ending balance is more than the beginning balance, we're not collecting the sales for the period. In fact, we're collecting less and we're building our accounts receivables. Make sense? Now let's see the opposite scenario. So again, if you want me to repeat, if the ending balance, as you can see, the ending balance is more than the beginning balance, that means we're not collecting the sales that we're generating from the period. Because income statement here is prepared for the period of time. We're not collecting our sales for that period. That means we're building up our accounts receivables. And we can see that build up in accounts receivables is $30, correct? We were 20, now we are up with 30, now we are 50. Now the $30 build up affect directly my collections. Instead of collecting 100, I'm collecting 70. Why? Because $30 still sitting in my accounts receivables. Make sense? Okay, let's keep going then. That's one possibility. Let's see the other possibility. Let's forget about this. This formula gone, this one are gone, this cash 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 gone. So again, our sales are 100. My beginning balance, let's put it now 70. At the end of the period, I have ending balance of 20. How much cash I have collected?
150.
Okay, I'm waiting for more people to confirm on that number. Stella, what do you think? How much cash we collected?
I think 150.
Are you sure about it? I need your solid yes or no.
I think yes.
Then stop thinking, say yes. Eliminate I think.
Yes.
I want you to be sure. Yes. 150, that's how much exactly we collected. Why? Because those 100 is going to come here, correct? So what's going to happen now? We're going to have 70 plus 100. It's going to be equal to question mark plus 20. And our question mark will be equal to 170 on one side minus 20, and that's going to give us $150. So those $150 is going to come here. Did we collect our sales for the period? Most likely we did. What else we collected? We collected $50 from the previous period. Make sense? So what's happened in this case? My ending balance is less than my beginning balance. Is that good for us in forms of cash? Absolutely. We're not gonna wait for the clients to pay us. They even pay us more than what our sales. So I'm collecting my sales for the period, relatively speaking, and plus I'm collecting $50 from my accounts receivables. My accounts receivables going down. So what's the good for the company and for the company cash? To increase the accounts receivables or to reduce the accounts receivables? On which scenario I'm getting more cash? In here, when I'm increasing accounts receivables, or here when I'm reducing accounts receivables compared to the sales. When I'm increasing accounts receivables, I'm not getting the sales. When I'm decreasing the accounts receivables, I'm getting the sales definitely plus extra from the previous period. All right, this is for accounts receivables, cash in. Now let's see what's the other stream of cash. The other stream of cash, I'm going to start from scratch again. So you cannot accuse me of cheating here. Let's start with scratch. Now we're going to start chasing where is the cash going out. Let's chase the cash out. Now, during the normal operation of the company, we have to pay. Either we're going to buy assets, either we're going to have expenses, but the thing is we have to pay for those things. So what we're going to have? First, we're going to have our cash account, which again is the balance sheet account, which has normal debit and credit and beginning balance and ending balance. That's our cash. That will be my debit again, and that will be my credit here. What else I'm going to have? As we said, beginning balance, and we're going to have the ending balance. On the other hand, all the way on the other side, we're going to have the expenses, which expenses are income statement accounts, correct? Which account doesn't have beginning balance, doesn't have the ending balance, it's just cumulative account, which at the end of the period is closed directly to income summary account. And that account is going to have debit and it's going to have credit. What's interesting with these expenses are always on the debit side. So increasing the expenses here, we're gonna see on the debit side and debit side only. So if I have expenses of $100, what do I have to do? I have to pay them, correct? Every time when I have expense $100, I have to pay cash of $100, correct? And the cash gonna go down on the credit side. Debit's gonna come on the debit side, cash gonna go down on the credit side. My job is done. Again, the problem is, in reality, that's not always happen. In reality, that chain, it might be broken. What will be on the middle? Even the, thank you. Does everybody see what is in the middle?
Accounts payable. And the reason
Accounts
is
payable.
because like the on the left side we're crediting the cash, so that's why, and on the right we're debiting it. That's where accounts payable.
Come
Sorry,
in place,
yeah, come in
correct?
place.
Perfect. Excellent. So in the middle, I have to add new account, which account now is, I can view from this account because that's also will be balance sheet account, but it's not, the name is not gonna be, and the beginning balance not gonna be on the debit side. That will be accounts payable here. And that will be clearly liability account. On the liability account, we know still gonna have credit and debit, but liability account, they have beginning balance on the credit side and ending balance on the credit side. So what's going to happen now? Our $100 now going to travel. First, from the debit on the expenses, they're going to stop. First stop will be accounts payable, 100. And then from accounts payable, they're going to clear, they'll be clear with our cash. Make sense? Let's put the arrows here. First one is that we getting the expense, we're not paying it. Later on, we said, okay, let's pay these people, and we pay the $100. And now our job is done. We cleared the accounts payable. Now, let's see on the cash side what we have. The cash side, the equation is not going to change. It's going to be beginning balance plus debit is going to be equal to the credit plus ending balance. On the accounts payable now, we're going to have different. We're going to have beginning balance plus credit should be equal to the debit plus ending balance. So now let's play with the scenarios. First scenario, obviously, will be my beginning balance is, those beginning and ending balance should be on the other side. So my beginning balance is 0, my ending balance is 0. How much cash I paid for the $100 expenses? $100. Is that obvious for everybody? This account is gonna disappear, and whatever we pay here as expenses is gonna get out of the cash. And now we're gonna start playing with the same idea with accounts receivables, but different scenarios. First, let's add it here. No, here will be $100 coming here and $100 going out of here. Done. Now, in the next scenario, let's add an imbalance. What we're gonna do? We're gonna have $100 expenses. We don't know how much cash. Our beginning balance is going to be 0. At the end of the period, we're going to have beginning balance of $30. Question is, did we pay for cash for our expenses? First, before we go, did we pay for our expenses, cash? Yes or no? Did we pay all the $100 expenses? Let me paraphrase the question.
I think we just paid 70.
No, we didn't. Now the question, second follow-up question is how much we paid.
You paid 70 actually. That's what I
$70,
meant.
right? So how are we going to do that? Beginning balance is 0, right? Plus, in accounts payable, we increase the accounts payable with 100. And that's going to give us the question mark, how much we paid, how much we reduce it, plus the ending balance, which is $30. So what we're going to have? We're going to have the question mark to be equal to, on one side, we're going to have 70, on the other side, 100. I want to get 70 faster. Minus 30, and that's going to give me $70. So I pay here only 70, and here 70. Make sense? Let's go one step further. Let's do the other option. This one gone, 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 and this one gone, and this one gone. Now, my beginning balance is 20. My ending balance is 0. Logical question is, how much cash we paid? My God, you're getting now experts. You're just jumping right away. Is that getting easy now?
Yeah, to a degree.
So what's happened now? Those $100 gonna come here. Something have to go out. We don't know yet how much is it. But if we use the formula here, what we're gonna get? We're gonna get 20 plus 100 to be equal to question mark plus 0. And from this equation, question mark will be equal to 120. If I decrease my accounts payable with 120, that means I have to pay cash 120. Make sense? Let's start now playing with a little bit more difficult game. My expense is 200. My beginning balance is 50. My ending balance is 70. How much cash I paid? Good job. Any other guesses? Monica, think again. Stella, no guesses here. No, so let's go with the formula. If this is tricky, let's go with the formula. What's the formula says? We have 50, correct? We are at 100 here. we have 50 plus 100 should be equal to what? Question mark plus the ending balance, which is 70. Correct? No. This is my expenses. Ah, I see. Okay, sorry. So where's the question mark? Let's solve it with the question mark. Stella, your turn. What we getting?
So 150 minus 70
So how much is that?
is 80.
80. So how
Okay,
much? So how much cash we paid?
80.
$80. Let's see what's happened in this case. Our expense is 100, no questions about it. But what's happened with our, now when we comparing beginning balance versus the ending balance is higher than the beginning balance, correct? So we're building accounts payable. If we're building accounts payable, that means we're not using the cash. We're preserving the cash. That means we're paying less than the expenses for the period. Make sense? How much we increase our accounts payable? $20. How much cash we pay compared to our expenses? How much less cash we pay for our expenses? $20. Why are we paying $20 less? Because for the $20 expenses we didn't pay. That's our increase in accounts payable. Every time when accounts payable goes up, that means we're spending less cash than our expenses. Now let's see the other scenario. What's going to happen if this one's gone, this one gone, this one gone, this one gone, this one gone? The expense is still 100. This one gone, this one gone, and this one gone. Now, my beginning balance is 70 in this case. My ending balance is 10. My expenses are still $100. How much cash I paid? Great job. I have already have one answer. I'm waiting for another person to jump with the answer. Yomao, great. Monica, Stella,
160.
Antonia. What do you think? Maybe she's here, maybe she's not. Okay, let's go now. Let's calculate it. Stella, you're right. What we have, 70 plus our 100 here, and that 100 is gonna come here, plus those 100, should be equal to question mark plus 10. So when we solve it for the question mark, what we're gonna have? 170 on one side minus 10 is gonna give us 160. So we're gonna pay 160, and those 160 gonna go out from our cash. So what we can conclude? We can conclude that if the ending balance is less than the beginning balance, we're reducing our accounts payables. but we're also reducing our cash. The reduction in accounts payable, it's going to give us the extra cash that we have to pay above the expenses for the period. Make sense? Now, what's the difference now? If you ask me now, what's the difference between direct method and indirect method, which we're going to start now doing the indirect method. But before I show you the indirect method, I want to show you something else. Here, this spreadsheet. What I'm going to do is something very simple. Let me increase the font first. I'm going to grab from this calculation for the cash in. No, let's stay with the 0. Oh, no, this one. Let's go with this one. And then I'm going to grab the other calculation, which is for the cash out. Can you guys see it?
I can see it.
Okay. So what we can see here is sales increase the cash. But first going to the accounts receivables and then going to cash. Expenses reducing the cash. But first they're going to accounts payable and then going down to cash. Sales minus expenses. What's going to give us?
How much cash we have altogether?
No. Only sales minus expenses. What's going to give us?
Revenue or how much you made?
Net income.
Okay.
Make sense? Are we agree that the sales minus expenses is going to give us net income?
I agree.
So, for that reason, can we skip, instead of doing sales and then chasing the accounts receivable and cash, can we just start with the net income and then see what's changes in the accounts receivable and what changes in the accounts payable, and to figure out what's happened with cash? Can we do that? So watch this carefully. If we have to do the direct method, we're gonna count first from sales, then we're gonna add accounts receivables, and from those two, we're gonna figure out how much cash we collected. And then we're gonna see the expenses, changes in accounts payable, and we're gonna see how much cash we paid. That's direct method. In the indirect method, we're working with the net income, which net income automatically have the sales and expenses. And then we start chasing what's happened with accounts receivables and what's happened with accounts payables. So now you know which one is direct, which one is the indirect. Indirect is the one that we're going to practice. If you want to get the direct method, come back to this calculation Excel spreadsheet, and you're going to see the direct method. Now, next time when you go to for those of you who go with the intermediate accounting one, and when Shirley starts asking you for direct method, you have the calculation here. All right. Let's go. Let's go back.
Can you upload that onto Blackboard and tell us, like, the cash in is the direct method while the cash out is the indirect method?
Okay, so this one is the direct method, direct,
Okay.
and an indirect, it's gonna be, we're gonna eliminate this one. We're gonna eliminate this one, and we're gonna sell cells. So let me completely eliminate them. Because it's the merge. Okay. Let's unmerge them. We're gonna completely eliminate this, and we're gonna say here net income. Income statement. From the income statement, we're gonna get sales. And then we're gonna add the expenses. And that's gonna give you net income. Net income. Now in our scenario, sales were 100 and the expenses are 100. So our net income is 0. That's how we started, correct? So that's why those 100 is gonna come from right here, and those 100 is gonna come from right here. And now you have your sales and expenses. All right, so that's with this calculation. Let's go back now to slides and let's follow the slides now. So again, indirect method. In the indirect method, only difference from is the operating activity sections. This one is the reconciliation from the net income. So we're gonna get the net income, which gives us operating activities, since the net income for the current period, which happen all the operation that's happened in the operating activity. The only thing that we have to do in the net income now is to convert the accrual basis net income into the cash basis net income. How are we going to do this? I'm going to explain in a second. Now, what's the drawback? The drawback here, we're not reporting the sales and expenses, which collection with the customers and payments to the suppliers. But this the indirect method is mostly used in the practice, widely used in the practice. So how are we going to do in the indirect method? Once we see the net income for the company, we're going to start thinking, is there anything on the revenue side and the expense side which we don't have to pay with cash? If we see something for which we don't have to pay cash, now if it's expense, we have to add it back. If it's revenue, we have to deduct it. Why? Because again, we're starting with the net income. If there's an item on the expense side, which is not cash, that increasing the expenses, which reducing the net income. So if you want to eliminate that effect, we have to add it back. If it's in the revenue, but we're not getting any cash for that, which is gain, as you already know, gain, there's no cash with gain, but the gain increase the revenue on the income statement, then we have to eliminate it by deducting it from the income statement. I'm going to repeat this over and over again until we get comfortable. And we're going to start using it in our questions. Let's see first thing first. This is our questions that we have to deal with. Let's start with this one first. I agree, it's a little bit complicated out of the blue right now. Don't get scared. Stay with me. We're gonna go one after another. I already copied it. Let's move to the Excel spreadsheet. No, I don't want to do that. I'm probably gonna start from the clear new worksheet. Let's start with the new clear worksheet. That's our picture. This is our income statement. If I have to prepare cash flow statement from the operating activities only, using the indirect method, first thing that I have to start with will be company name. Second thing that I have to put is the name of the statement. Next thing, I have to put the period for the statement. Now, since this is the statement of the cash flow, statement of the cash flow is prepared for the period of time, not at point of time like a balance sheet. For that reason, we're going to say for the year ended December 31st. Then we have to write which section of the statement of the cash flow we're preparing, and we're preparing operating activities. And we can put now here cash flow from operating activities. And we're going to see later how exactly terminology is. Starting point is first net income from the income statement. That's our net income. Our net income in this case is $100. Can you guys see it?
Yeah, I can see it. It's on the bottom.
Right. Okay, let's keep going now. First thing that we have to do is we have to adjustments for non-cash items. Now, with the cash flow statement, you have to understand the textbook explaining one thing. Different teachers is going to give you different scenarios and different ways to prepare the cash flow statement. The way I'm teaching it is a very unique way to teaching the cash flow statement. Later on, with moving from me to another teachers, you're going to see their perspective on the income cash flow for the cash flow statement. If you look on the internet, you're going to see different ways explanation of the cash flow statement. What I have to tell you is, even though the interpretation and different people tell you different story, I'm going to give you the essence, the most important parts of the cash flow statement. And once you learn it the way I'm teaching, it doesn't matter how many teachers you're going to change. The logic will always going to be the same. So let's go. First, we're going to make adjustment for the non-cash items. Now, for the non-cash items, we have two options. Either we're going to add it back either we're gonna deduct it. Now, which item we're gonna add back? We're gonna add back items which are affecting our net income in the negative way. For example, let's see, we have this here, revenue gain and everything. Let me see from the slides if I can get no, I cannot go inside, it's not Excel spreadsheet, so I cannot do anything with the slides. Let me go back here, and now what we're gonna see? We're gonna have a revenue. And after that, we have sales revenue. We have interest revenue. We have dividend revenue. Those are our sources of revenue, correct? And we have here 682, then we have 29, and then we have 22, and then we have gain on sale, which gain on sale is 90. And that's combined, all combined, give me my revenue for the period, 752. Then I have expenses. And I have cost of goods sold, salary expenses, then I have amortization. Next thing I have is other expenses, interest expenses, and I have income tax. So let's see on those expenses what we have. Cost of goods sold is 360, 134 here, 30, 43 here, 41, 38, and the next one is 36. My total expenses are 652. My net income for the period is equal to 752 minus 652. Can you guys see it? Let's bring this one here. Now the question is, my starting point here is $100, correct? Which is right here. Now I'm trying to adjust for the non-cash items. So, which of those items I have to pay with cash? Which of those items I don't have to pay in cash? Can I buy amortization?
No, you can't.
So is this cash? No. So I have to eliminate it. If I eliminate that cash and put 0, what will be my operating income? Can you
I'm
see it?
guessing the net income,
Watch my screen. Can you see it? What's happened with my income?
yeah, it's gone up.
Gone up 133. So what do I have to do? I have to increase this income because this is my starting point. If I don't have amortization, my income is gonna go up. So what do I have to do? I have to add amortization. Make sense? How much is my amortization? 43. Are you guys with me?
Yes, I'm with you.
If I add amortization, what will be my new calculation here?
143.
Is that what I'm chasing?
Yes. At
There you
least
go.
the cash.
You added amortization. Does that make sense now? Why are we adding amortization to the net income? So any expenses which are included into the net income on the original scenario, it has to be added back to eliminate the effect of that expense. Because that expense reducing the income. If we don't have it, our income is going to go up. For that reason, we have to add it to the starting point of our calculation using the indirect method. Make sense? Now let's see what I have to deduct. Let's forget about the net income here, amortization. I'm going to bring it back. So now, and I'm going to get rid of this amortization. We're going to come back to this later. Let's see what we have to deduct. Can I buy gain with cash?
No, you can't.
What's the gain then? Simple calculation between the selling price and the purchase price, correct?
Yeah.
So, is in the $19 gain, is the cash involved? No. So, what's going to happen since this is the gain on sale, which affect my income, correct? Or revenue and gain, which bottom line affect my income. What's going to happen if they eliminate the gain and bring it down to zero? What's going to happen with income? Going to go up or going to go down?
I was thinking it was about to go down. Something wrong?
What's happened with the income? It went down, right?
Yeah, it went down.
So what I have to do here with any item which affecting my income or revenue on the positive side, I have to deduct it to eliminate the effect of that item. Make sense? So for that reason, we're going to deduct gain on sale of long-term assets. And we're going to deduct here minus 19. Once I do that, my adjusted income is going to be 81, which is what exactly I'm chasing. Make sense?
Yeah, but like with amortization,
Now we're going to now we're going to see the both effects.
okay.
So hold on a second. I just wanted to see you to see first the effect of every single of those items. Now we're going to combine all together. Make sense? So let's bring the amortization. Let's get rid of the amortization 0 and get rid of the gain. Where's my income? 124. So that means here I have to achieve that will be adjusted. And that will be cash in this case, income, in the adjusted net income, which will be equal to the cash income. So if I add back that 43 for my amortization, my adjusted net income is going to be 142. Is that the number here that I'm chasing?
Yeah, it is.
So that's how we're moving from the accounting income into the cash income. By eliminating effect of the non-cash items, which non-cash items in this case is gain and amortization. If it's expense again, if it's expense, we have to add it back. If it's included in the revenue and gain, we have to deduct it. Step one is completed. Let's have a break and we're going to move to the step two. That is correct. First step is to identify which one is the non-cash item. Think about it of the effect of that non-cash item on the net income, which is the starting point. And we have to, again, if it's expense, include it in the expenses. That means reducing the income. So we have to add it back. And if it's gain, that means increasing the income. We have to deduct it to eliminate the effect of that item. And don't worry, I'll try to go to the whole possible scenarios of adding and deducting. So once we have all those possible scenarios, there's nothing else. Obviously, here we're going to have amortization. And the other one we have to add, if we have it in here, that will be loss. But we're going to come to this a little bit in the different questions. So let's have a break a little bit. Because I kind of want you to take a little bit break, process what we just talked about, and continue. So the step one in the cash preparation of the cash flow statement, operating activities only, under indirect method, the first step is to move the net income, accounting net income, into the cash net income. How are we going to do this? We're going to adjust for the non-cash items. Again, if it's included in the expenses, we have to add it back. Or put it this way, if the inclusion is in increasing the net income or reducing the net income, it is increasing the expenses, which means reducing the net income, we have to add it back. If the inclusion is in increasing the net income, means part of the revenue, then we have to deduct it. That's why we're chasing the amortization expense. And since we don't pay for amortization expense cash, we have to add it back. If we had loss, we're also going to add it back. Gain, on the other hand, increasing the revenue means increasing the net income, but it doesn't have cash effect, so we have to deduct it. So at this point, we come up with the adjusted net income. Now let's move to step two. That was step one. Now, step two, we're done with the income statement. Income statement is no longer interested. This part here, I can easily erase it. You already have it in step one. You don't need it here anymore. Now, the next thing that now we're moving to, since we did adjustments for the non-cash items, now we have to do and chase. Yes, you are. You are very good at this. I can guarantee you. So adjustment for the net income, once we do those adjustments, now the next thing is to chase and find out the changes in the working capital. Now the question is, what was the working capital? Working capital, don't forget, that's a current assets and current liabilities. Where are we going to see those changes? We're going to see those changes in the balance sheet. So let's pull, I'm going to get out the balance sheet from the slides. Now the balance sheets here, they have something which I don't like, but I have to live with it. And let's work with this. This is our balance sheet. On the balance sheet, first thing we have to identify is which is part of the working capital. Since we know the current assets, we're chasing only current assets, current liability, nothing more, nothing less. First line is cash, as you can see. We're not concerned about the cash because the purpose of the cash flow is to explain what's happened in the cash. As you can see, we have a decrease in cash with $4,401. The cash went down to 57. With preparation of cash flow statement at the very end, we're gonna find out why this happened. So cash, we're not worried about the cash. Second item is accounts receivables. The question is accounts receivables current assets? Yes, it is. Excellent. So what we're gonna do once we find out the accounts receivables, so what we're gonna do is changes. Oh, just gonna go accounts receivables. So what we're gonna do? For accounts receivables, we're gonna get the beginning balance minus the ending balance. Beginning balance accounts receivables minus the ending balance in accounts receivables. So how much is my beginning balance? 192 minus ending balance is 224. What's the number that we're getting here? That will be equal to 192 minus 224. We're gonna get minus 32. Now let's think about this number for a second. What's happening with the accounts receivables? Are we building accounts receivables or reducing the accounts receivables?
We're reducing the accounts receivables.
Think about it. The beginning balance, where is the ending balance? Higher than the beginning balance or lower? Increasing. We're increasing accounts receivables. So let's go back to our
Yeah.
charts. Here, if the ending balance in accounts receivables is higher than the beginning balance, did we collect the revenue? No. For that reason, those $32 explaining that from the net income that we started, that income has revenue, but out of that revenue, we haven't collected $32,000. Why? Because our accounts receivables going up. Does that make sense?
Yeah,
So
because like in 2022 we had 192 for accounts receivables.
correct,
In 2023 we had 224. That's
correct.
kind of tripped me up. It's just that like the 2022 is at the back. That's why.
Right. But that what that means to us, that means we building the accounts receivables, that means we're not collecting cash. How much exactly we didn't collect from our sales? We didn't collect $32,000 from our cash on our sales. So that will reduction in our cash. So let's see the next one. Interest receivable. Is this current asset or not current asset?
It's a
Current asset.
current asset because like interest you have to pay it within 1 year.
Correct. So let's go. Interest receivable. I'm gonna do those abbreviation here, part of the abbreviation. Again, the same idea. Beginning balance of the interest receivables minus the ending balance of the interest receivables. Where is my beginning balance? Here. In brackets, I have 3 minus 8. Based on the formula, I'm going to have 3 minus 8. That means minus 5. What that means to me? That means my interest receivables also increased. That means the interest revenue that I generating, I haven't collected. $5 still sitting uncollected. Make sense? Okay, let's move to the next one. Inventory. Is this current asset?
Depends on the situation. Like if you were selling
There,
salad,
no. There's no depends on the situation. Inventory. Current asset or not current asset? Yes or no?
I was thinking it's not current. Okay, never mind. My
Totally
mom
current
said
asset.
yes.
Totally. Totally current asset. So, how are we going to do with that current asset? The same thing that we did before. Beginning balance of the inventory minus the ending balance of the inventory. So, what is our beginning balance here? Beginning balance is 330 minus 323. If we apply the formula, it's going to be 330 minus 323. $7 increase. Let's think about logically. What's happened with the inventory? Are we building up inventory or are we reducing the inventory?
We're reducing the inventory.
That means we're selling the inventory. Which
Yeah.
we're selling the inventory, we're collecting cash. That we're converting inventory into cash. Make sense? How much we reduce the inventory? With $7. So that 7 flowed into our cash. Next one, prepaid expenses. Is it the current assets or not current asset? Current. I agree with you. Prepaid expense. So what we're gonna do? Beginning balance of the prepaid expense minus the ending balance of the prepaid expense. What we're gonna have in the brackets? We're gonna have 17 minus 18. Once we get the numbers, we're gonna have here 17 minus 18. So our cash went down with $1. What that means? Did we increase the prepaid expenses? Yes. That means we use the cash to pay for those expenses. So our cash went down with $1. Is there any more current assets? Are we done with the current assets? No more. We're done with them. Okay, perfect. Let's go with the current liability now. Accounts payable. Is that current liability? Yes. No questions about it. Let's go with accounts payable. Now, in accounts payable, we're going to apply the same formula like the assets, but now we're moving to the liability side. So the liability side means deduction going on the opposite on the cash. Remember, the beginning balance now moving to the credit side. To eliminate, to account for these changes, in front of the brackets, I have to put minus. And then in the bracket, I'm going to put exactly the same. Beginning balance on accounts payable minus the ending balance of the accounts payable. So what I'm going to have here, again, I'm going to have negative bracket. Beginning balance is 137 minus 220. So now my formula is going to have minus bracket 137 minus 220. Close the bracket. That's gonna give me increasing my cash with $83. Let's think about it for this. What happens when we increasing our accounts payable? We already saw that effect. When we increasing our accounts payable, we paying less cash, correct? Than our expenses. So that means we're preserving our cash by not paying our cash, but still having the expenses, correct? That give us a increase in our cash with $83. Let's move to the next one. Salary payable. Is that current liability?
Yes, it is.
Yes, it is. Let's go with the salary payable. The formula again is going to be same. Negative beginning balance of the salary payable minus the ending balance of the salary payable. And again, we're going to have negative 7 minus 5 in the brackets. So where we are here, negative bracket 7, no, sorry, 12 minus 6. I'm on the wrong line, right? Sorry, my bad, sorry. Getting tired, I guess. Let's go and change those numbers. That will be here, 12. Thank you for correcting me and paying attention. So now let's go here, equal to negative bracket 12 minus 6. Close the bracket. That have a negative effect on our cash. Let's think about for a second. We pay our salary payables for the period, for the salary expenses, plus we reduce our salary payable with $6. That means we use extra $6 cash more than our expenses, correct? So that's going to give us deduction on our cash. Now let's go with the last item, which is the accrued liability. Is that current asset?
You said
Obviously,
you said it's current asset? No, it's actually
it's a current
a
asset.
liability. Oh, okay.
It's a current liability, it's a current asset. So let's go with again.
Yeah.
Beginning balance of the current liability, accrued liability, minus the ending balance of the accrued liability. And again, we're going to have here negative in the bracket 7 minus 5. And that's going to give us negative bracket 7 minus 5. Negative 2. What that means? We paid for that accrued liability $2 to reduce the balance from 7 down to 5. Correct? Are we done with our working capital? Since we are done, right? Looks like we're done. Okay, let's see what's our effect. Once we combine all those items, we're gonna get total of $44 increase. So our last item here will be, if we want to do it correctly, let's put it this one. I'm gonna cut it from here. I'm gonna paste it here. I'm gonna increase that column. I'm gonna get this 44 cut and paste it here. And now we're gonna have cash from operating activities. And that will be calculation between those two numbers. Obviously, that's not the right calculation, so I have to go here, just the formula. And that will be my correct calculation here, if we put it this way. And that's my cash from operating activities and $168. So this company from the operating activity that's generating cash of $168, which is positive. That's a good sign. Now, one thing that I have to note here, no one teaching a cash flow statement this way. However, if you follow this step, you're never gonna make a mistake ever when you're doing cash flow statement. What you have to do is every time when you see the current asset, remember beginning balance minus the ending balance. See the effect on cash. Plus, minus, see it. If you see the number, think about it. Is it make sense to be minus? Well, it makes sense because I'm building asset. If I'm building the asset, I'm not collecting cash. If you're reducing the asset, that convert into cash. For the liability, in order this to work, you have to remember liability is on the other side of the accounting equation. So the beginning balance is on the credit side. For that reason, put one minus in front of the bracket, apply the same formula, beginning balance minus the ending balance. And then think about it. My accounts payable going, my liability increasing. That means I'm not paying, I'm not using cash. If the liability going down, that means I'm using more cash to pay that liability, to clear that liability. Again, I have to be honest, no one teaching the cash flow statement the way I'm teaching it. But if you follow this simple logic, you will never ever gonna make a mistake on the cash flow statement. On the operating activities, we're talking about the operating activities here. We're gonna apply the same thing. I'm gonna show you the next investing and financing, how that works, but I think today doing operating activity, that's more than enough. So let's go back to slides and see what the slide's gonna show us. Again, we're starting with the income statement first part, and then the balance sheet. We're starting with the balance sheet. Now, as you can see, the slides are a little bit different, but the main things stay the same. First, we have the net income. Then we're doing adjustments for the non-net cash item, adding amortization, deducting the gain. After that, we're chasing the changes in the working capital. Increase in accounts receivables have a negative effect on any increase in the assets have a negative effect on the cash. Any increases in the liabilities have a positive effect. And as you can see, the net cash from the operating activities is 168, the number that we have. So again, on the preparation of the operating activities, we're starting with the net accounting income from the company. Then we're making adjustment for the non-cash items. If there's something that reducing the net income as expense or losses, we have to eliminate that reduction by adding it back. If it's an item that increasing our net income as a gain, we have to deduct it. After we do that, we're gonna come to the cash net income or In our case, we're going to call it adjusted net income. After that, we're going to start chasing changes in the working capital. And that will be, again, for the current assets, remember, beginning balance minus ending balance. For the current liability, minus bracket, beginning balance minus ending balance. And here is the simple chart, which is similar to what we did. If it's amortization, depreciation expense added to the income. If it's gain, deducted for the net income. If it's losses, added back. If you have increase in the current asset, deducted. If you have decreases in the current asset, added back. If you have increases in the liability, then that's positive effect on the cash, increase the cash. If you have decrease in the current liability, that means we're paying more liability from the previous period. That's negative on our or decrease in our cash. And that's our operating income. I believe we have 15 minutes, 14 to be exact. Let me find one question and let's go together over one question for cash flow statement. Trying to find some simple question, which is not going to take us a long time, but again, we're going to repeat everything that we just said at this point. This question, I believe, is perfect. We don't have so many items. Perfect. Excellent. So I'm going to move to Excel spreadsheet and I'm going to share my screen. Just give me a second and I'll be right with you. Okay, I'm ready and let's go. I'm gonna share my Excel spreadsheet, which should look like this. Now, again, I'm not gonna use this. This one will disappear, but I'm gonna copy and paste something different in this case. Let's grab this company and let's start preparing whatever we prepared here with the same logic. We're gonna start using on this company. Now, we know that the effect, so I don't have to keep this part. I can easily delete it. And that's our starting point. Let's get rid of all those lines here. Amortization, we're gonna move it. Gain, we're gonna just net income. And let's start. This is the balance sheet. And we have the income statement of the company. So balance sheet, we're gonna leave it for now. And we're gonna start with our income statement. Can you guys see my screen?
I can see it.
Okay. Question. What's my starting point for my cash flow statement?
I think it would be operating expenses, but
Net income.
yeah, net income. Okay.
How much my net income? Or their net income, not our net income, their net income. Their net income is 93,800. That's our starting point. After that, we have to do adjustment for the non-cash items. Is there any non-cash items that we can see on their income statement? Let's go. Sales. Sales. That's part of the cash. Cost of goods sold. That's expense. Depreciation expense. Do we have to spend cash on the depreciation expense? No. How the depreciation expense added into the expenses affect my net income? Reducing it, correct? So if I want to eliminate that effect of reduction, I have to add it back to bring the income to the point that I don't have this expense. So let's add it back. That will be my depreciation expense. And I'm gonna add back exactly $25,200. Is there anything that I have to deduct from my net income? Is there any items which affect my net income in the positive way, which I have to eliminate? Now, cost of goods sold, that's related to sales. And cost of goods sold, those are paid cash because those are expenses which I have to pay. So for that reason, cost of goods sold, that's a cash item. And yes, we're done with this. That's the only thing that we have. No more deductions. So our adjusted net income is equal to those two items and those two items only. That's our step one. Now we have our adjusted net income. Now we can move to step two. Step two is, let's move it right here. Step two is to start. Let me delete this worksheet. I don't need it. That's my step two here. On the step two, I'm going to push down the income statement and I'm going to bring up a little bit the balance sheet. On the balance sheet, I'm going to start chasing the changes in the working capital. Which working capital again is the current assets and current liabilities. Cash, we want to see through the cash flow what's happened with the cash. So in cash, we're not dealing with the cash. Second item is accounts receivables. Is that current asset? Yes, it is. So let's account for it. Accounts receivables. What we have to do? Beginning balance of accounts receivables minus the ending balance of accounts receivables. So our formula will be 37,800 minus 43,400. So where we're gonna be? We're gonna be 37,800 minus 43,400. $5,600 reduction in our cash. Is that make sense? Are we building accounts receivables? Yes. If we're building accounts receivable, that means we're not collecting the sales. We collected the sales, but we collected only that much minus $5,600 because now that part of the sales sitting in accounts receivables uncollected. Next one, merchandise inventory. Is that current asset? Yes, it is. What we're gonna go with the inventory? Same thing. Beginning balance of the inventory minus the ending balance of the inventory. Or we're gonna have here in the bracket, we're gonna have 249, 200 minus 284, 200. In my formula, I'm gonna 249, 200, 200 minus 284, 200, and that's gonna give me another deduction in my cash, 35. What's happened? My asset inventory went up. That means I purchased more inventory. I use more cash to purchase to increase the inventory. Any more current assets? Do you see any more current assets? No, I don't see either. Let's move to the next section, liability and equity. Do we see current liability? Accounts payable, okay,
Yeah, that's what I was about to say.
right? So when you move to the liability, don't forget to put that minus in front of the bracket. Beginning balance of accounts payable minus ending balance of accounts payable. So what's going to be here? Negative bracket 44,800 minus 32,200. And if I have to calculate, it's going to be minus bracket 44,800 minus 32,200. What will be the effect on my cash? Reducing my cash with $12,600, correct? Does that make sense? What's happened with my accounts payable? Am I building accounts payable or decreasing the accounts payable? Decreasing accounts payable, which means I have to use more cash to clear that. Next item, income tax payable, current or non-current asset? Current assets, let's go. Income tax payable. What is gonna be? Again, don't forget the minus in front of the bracket. Minus, bracket, beginning balance, income tax payable, minus, ending balance, income tax payable. Close the bracket. So now in the bracket, I'm gonna have negative 11,200 minus 12,600. Close the bracket. And in the formula, I'm gonna have minus bracket 11,200 minus 12,600. 1,400 increase in my cash. Does that make sense? Am I building accounts tax payable? So that means I'm preserving, I'm not paying the tax payables. I have it as an expense. Here, income taxes, I have it as an expense on my income statement, but I'm not paying it. I haven't paid out of those 96,600, I didn't pay $1,400. So that means I'm preserving my cash. That's gonna have positive effect on my cash. And that's all the changes that we have here. So what I can do is I can simply gonna cut those one, gonna paste it here. Sorry, the cutting should be like this, Control X, Control V, make it this wider to get this one. Then I'm gonna have my net effect here, which net effect I'm gonna move it into this column. That's gonna give me this calculation here. And my cash from operating activity it's going to be equal to those two numbers. Again, it's not going to give me that, so I have to adjust the formula. Once we adjust the formula, we're going to get the effect, and the cash from operating activity is 67,200. Let's put it in the proper formatting, and we're done. Now, if we have to see the answer for this question, to see are we doing it correctly, the answer will be right here where the question is. And the first part will be 67,200 net cash flow from operating activities. And that utilizes our time